Well, thank you, Dan. Good morning, everyone. Thank you to the Institute of Managed Account Professionals for the kind invitation. My topic, as Dan said, is really talking about how dynamic can you be in managed account portfolios. And I'm going to go through a number of topics in a reasonable sort of short space of time. Try and make sure that you're getting to morning tea around the appropriate time. So, following on from the last two sessions, for us, managed accounts, some similar themes: personalized profile, being about sort of meeting the specific client needs that we were given by a number of advisors and dealer groups in 2012. I'm going to give you some of the kind of the 5-year experience of us working with managed accounts in Australia, and also some of our global experience from the US. About being sort of long-term valuation-driven asset allocators. That's us too. And to pull those two together, how can you bring together long-term valuation-driven asset allocation in a managed account format where you're meeting client needs? And I'd say sort of, very broadly, kind of three things. How dynamic can you be is really about how dynamic do you need to be to increase the probability of meeting client outcomes over the longer term. Being dynamic per se has no value to the client if it just eats up costs and taxes. The end client outcome, how happy they are with the outcome, is going to be obviously dependent on investment returns, but dependent on the whole experience. And that's about a successful collaboration about us as an industry, about how we get from the model manager, the platforms implementing the portfolios, the ETF providers providing product development solutions to able to us to implement, and the advisor in many ways communicating the outcomes and managing expectations. That successful collaboration is key to ensuring that the clients are happy with the journey. And for us, what it's really meant for us in that 5 years as being traditional managed fund providers is that we have had to invest a great deal in our operational infrastructure. We feel that we now have a best practice operational infrastructure to actually work with those platforms, ETFs, advisors, to enable the end client solution to be what they want it to be. And that's been our main learning. Think about managed accounts differently and make sure you have the operational infrastructure in place. So I'm going to go through a bit about Morningstar Investment Management and our global experience in managed accounts, investment principles, research resources, how that can help us to develop those dynamic portfolio construction sort of requirements. What were the specific client needs that we were given? And how do we see them today in 2017? And how do we continue to adapt, working with many of you as sort of industry colleagues and partners to develop that end client solution? So Morningstar Investment Management was previously discussed as, or named as Ibbotson, and goes back to days of Intech, where it's providing kind of implementing consulting solutions to a lot of institutions. We are a global firm. We are mainly a multi-asset investment management firm based primarily in Chicago, London, and Sydney. We combine investment management professionals with both research professionals on the equity research side, where we have over 200 people globally, and our manager research professionals. The key things that I want you to sort of to know from this chart is that we have all of those in Australia and Asia Pacific, as well as in London and Chicago. And in the US, we've got 15 years of actually managed accounts and actually own our own platform in the US where Morningstar implement those managed account solutions to end clients. We've been doing it in Australia since 2012, as I mentioned, 5 years experience. And broadly, we have over $1.5 billion of funds under advisement following our models that we set on a regular basis. The principles, putting investors first is a clear one, but what that really means is that we're thinking about fees, we're thinking about taxes, we're thinking about ensuring that the actual model return that we say is applicable for a particular portfolio is actually the model return that the investor experiences. When you're implementing through platforms, multiple platforms, potentially at multiple times, you actually want to make sure that in the outcome that you say that you are delivering is very consistent with the outcome that the client thinks that they are receiving. And that's been a kind of a key learning for us. In terms of sort of like main investment principles, long-term, valuation-driven, fundamentally focused about sort of particularly our equity research. We focus on cash flows. We don't focus on momentum or sentiment. And the key thing that I think that advisors and dealer groups come to us to receive as part of a model manager view is that fundamental valuation-driven asset allocation view with that bottom-up view from our equity analysts to actually pull the whole thing together into a portfolio that looks and feels like what clients have told their advisors they would like. So when we went to our colleagues and advisors and those that we worked with in 2012, they gave us a list of requirements that they would like managed accounts from Morningstar to look like. I'm going to go through those now, and that's been sort of instrumental in the way that we have designed the managed accounts that those clients have been invested in for those 5 years. It's not a managed fund approach. It's a very tailored, customized, thinking about the different tools. We are agnostic as to whether we view passive management, active management, ETFs, direct securities, managed funds. What we're trying to do is trying to make sure that we're meeting that client need. So the client needs that were given to us, I'm sorry, the bullet points here come out as G rather than as a bullet point. Hope you can look through that. But the particular client needs professional management. They were clear that they didn't want the factor of worrying about their superannuation portfolios at 3 o'clock in the morning. They wanted to outsource that to somebody who was doing that for them. Transparency was very important. You know, the particular kind of rush towards self-managed super funds potentially is about control, potentially is about transparency, but the dealer groups and advisors that told us what they wanted, transparency, being able to see exactly what was in the portfolio at all times was a key need. Beneficial ownership, and that leads obviously to your name or the client's name being on the direct securities that you're owning or the ETFs, and then from a tax point of view, thinking about the right way to sort of to structure that. Flexibility in terms of investment tools, not being kind of constrained to one particular type, either ETFs or managed funds. Fewer holdings. They felt that managed funds were complicating the communication to investors by just having hundreds of securities, or in some cases thousands. And what really investors wanted to do was say, at the barbecue, at the weekend, I'm invested in XYZ and I'm not invested in XYZ. They actually want to know what they're holding. Not sort of to say I'm overweight or underweight, or I've got 0.2% in this security and I've got 0.8% in this security. That tax effective structure, what's tax effective for a 20-year-old, what's tax effective for a 50-year-old, what's tax effective for a 70-year-old is obviously different. Managed funds tend to be influenced by the largest investor, sometimes the institutional investor. That's what you get if you invest in a managed fund. Managed accounts were designed to make sure that you can structure those portfolios to meet your particular tax needs. In some cases, reduced admin, particularly for the individual, and clear portfolio reporting so that you're not having to try and work out how your SMSF has performed that particular year. Now, initially in 2012, there were a number of challenges, and over time, we've sort of seen those as sort of become more opportunities. When we thought about actually trying to provide that transparent and direct ownership, at that particular time, the range of ETFs in Australia was particularly limited. The one area that I would say that we were most limited to at that particular time was mainly regional or global equity solutions derived on a market cap basis and mainly fully 100% unhedged. Now that's fine if that's what you want, but if you felt that there was better opportunities in a hedged environment or a regional equity solution that was not market cap based, it was very hard to get that into the portfolio. Now, fortunately, the first 2 or 3 years of that particular period was a period when the Australian dollar fell from above parity with the US dollar sort of through to kind of 70. So by being 100% unhedged in global equities was a reasonably good place to be. But obviously, as that sort of tide has turned and the valuation has become sort of more long-term neutral, then the need for thinking about currency, as David just mentioned, is absolutely paramount in how you access international equities. Education, what is a managed account? More people know about managed accounts now in 2017, but I think we as an industry kind of can sometimes complicate it by there's so many different kind of forms of managed account, but in 2012 it was pretty clear that not everyone knew what a managed account was. Dealer groups weren't always incentivized, or there was a slow take-up, And many SMAs were, managed accounts were generally Australian equity only. That's fine if that's what you're buying, but if you wanted that kind of holistic overall management of your portfolio that didn't just be kind of focused on the Australian economy or Australian equity beta, then and many investors felt that in their SMSFs they were fine with choosing Australian equities, but wanted actually the professional management outside of Australia. Then we had to kind of educate on how we build a multi-asset investment solution in a managed account environment. So how do we do it? We basically set about by kind of having a tiered approach, a 1, 2, 3 kind of preference, using the kind of the tools and using the investment vehicles available to us. We started off by trying to say, what can we buy directly? What are the securities that we can actually invest in directly so that the investor, the client, can see what they're invested in? Now, I should point out that at this time, and it still is mainly the case today, that the platforms that we have been working with are generally only able to transact ASX-listed investments. Now, that is changing, I'm fully aware, but generally in super and multi-asset, then the platforms remain constrained to ASX-listed investments. We hope that we're working with our platform partners to be able to change that in very short order. But so first of all, using Morningstar Equity Research, where we have a coverage list and a fair value and a view of quality, we put together a combination of Australian equities and Australian listed property trusts. To then get exposure outside of Australia, we thought about, well, what are the ETFs on the ASX that can enable us to do that? What are the particular ETFs that match with our long-term valuation-driven asset allocation view? And again, I'm pleased to say that the ETFs that we can choose from today in 2017 look very, there's much wider views and they're much more flexible tools than there was in 2012. And then where there was still a gap in trying to meet a multi-asset outcome, thinking about global bonds, thinking about alternatives, then we chose a Morningstar managed fund that was externally rated by one of the big research houses to try and plug that gap and ensure that the client was not being doubly charged for that solution. That was our approach. It remains our approach, although we have changed very much the kind of the positions that we're invested in over that time period. So all in all, kind of the general kind of education to the industry and to dealer groups was really all about that comparison of managed funds versus managed accounts. And there's a number of kind of points here which are kind of similar to what I've been making, but you can either have your managed accounts on the left-hand side where the major concern of advisors was the particular kind of focus on transparency and direct ownership of assets and the tax outcomes happening to you rather than because that was right for you, whereas on the right-hand side, managed accounts can work through all those different particular requirements. So we had a number of conversations internally about how do you build personalized solutions for customers that are operationally efficient, working with different platforms to meet those particular outcomes that you've set. And I'm pleased to say that we definitely discussed having different portfolios for different platforms or different portfolios for different dealer groups. In the end, we came down to the view that multi-asset investing is tough enough as it is. It's a huge investment environment out there, a lot of people trying to meet similar solutions, and we have stuck to our guns in terms of generally producing 6 or 7 models that are implemented through different platforms and for different dealer groups. All our investment team put all our knowledge and energy into developing the kind of increasing the probability of these portfolios meeting their outcomes over the longer term. And the particular focus we had on outcomes was more of an absolute return or real return focused outcome. And we felt it was really important to guide investors to thinking about risk as more about drawdown or the preservation of capital in drawdown environments. Just remember sort of the Buffett rule. Number 1, don't lose money. Number 2, focus on number 1. That it was really important with a kind of a managed account solution where managed funds were generally in that environment are talking about, benchmark-like solutions that we focused and differentiated on that in a long term, creating wealth through creating steady returns year by year, which basically, if you achieve that, will help investors to have that retirement income that they require. So we have effectively 5 or 6 models that meet kind of a particular risk tolerance, that are constrained around certain growth ranges, and we have a diversified income range. We do that by bringing together the valuation-driven asset allocation view, the bottom-up equity research of the analysts that we have around the world, and bringing it together in a way that kind of only the high conviction ideas get into the portfolio. Like, we're not in the sort of the business of investing in 2,000 securities. We're actually in the business of trying to keep the number of lines and investments that the client is seeing broadly around the kind of the 40 to 60 kind of range. Many of our portfolios at the moment have sort of 52, 53 lines of securities. Some of those are ETFs, and obviously there are lots of securities behind the ETFs, but in terms of what the investor sees, they might see 20 to 25 Australian listed securities, they might see 10 ETFs and some managed fund exposures. And over the 5 years, have we been dynamic? Well, I'd say we have, but I mean, we should also sort of be aware that over that particular 5-year time period, it's been one of the kind of the strongest periods for both equities and bonds for quite some time, and there hasn't been that many periods sort of to buy the dips. Early 2016 was one of the kind of the few exceptions to that. The major thing is that we've got access to a number of different asset classes, therefore we're multi-asset, and therefore we've met that particular need in terms of sort of diversifying the exposure for investors in 2012. The real kind of, I'd say the real action within this sort of chart has really happened within the major asset classes, within international shares, for instance, with the benefit of the products that the ETF providers have brought to the ASX. We've been able to have sort of focused exposure to kind of countries like Korea and Taiwan. We've been able to have a focused exposure to certain sectors like healthcare or telecoms. We've been able to sort of vary the particular exposure around currency. And the same with property and alternatives that have really kind of moved from, in property, kind of mainly Australian-focused solutions to global solutions. Of course, we've in that time period, with being focused on drawdown and absolute returns, we've held reasonable periods of cash and have invested those levels of cash when we've seen value in markets. But we do feel that generally both equity and bond markets are, in broad brush, overvalued right now. So we maintain a degree of cash waiting for better opportunities elsewhere. And over that 5-year period, have been able to sort of to deliver the CPI plus outcomes that our investors wanted from us. So turning sort of into the future, what are the next sort of challenges on the environment? How do we respond to those? And I'll come to sort of the operational infrastructure. Again, it's collaboration. I really feel that as a model manager, our clients only benefit from us all collaborating to get the best approach. So we work very carefully with the ETF providers. We work with our platform trading partners and particularly their market makers, particularly as the scale ramps up. When you rebalance a portfolio, you need to be very careful that you are not impacting liquidity, and you are making sure that actually your clients receive the price for a security that you think is the price for a security. We're working with research houses around data they are providing to be able to adequately compare managed accounts with apples to apples solutions, and also kind of the peer group benchmarking. Managed accounts are not managed funds. The reason why investors are choosing managed accounts is because that's what they want. At the moment, we find ourselves comparing managed accounts to managed fund outcomes, and you then need to be kind of cognizant of whether that's the right comparison for that particular investor. And of course, advisors. What the advisors need in terms of the information so that they can communicate and keep the investors on the path, so that the biggest risk to investors in long-term multi-asset solutions is jumping off the path at the wrong time. Jumping into something because the barbecue talk says, invest in equities because they've had a gun year last year, and not creating that wealth through steady, incremental portfolio creation. So, advisors are key. They are kind of the front line. We can only do what we can do. Advisors have to keep investors on that path. And really, as the scale within the managed accounts industry ramps up, we have to make sure that our business models are adapting to that. So the business capacity to be able to build multi-asset, the platform capacity. Again, we mentioned kind of hopefully the need for international solutions in due course. The communication to advisors. This is a key one that when you say you want transparency and you're offering transparency to your clients, they're then going to see changes, they're then going to ask questions. How are you going to deliver the responses back to them? And if you as an advisory firm are not getting the information that you need to respond to that transparency and questions, or if you as an advisor are not resourced enough to give that information back in real time to advisors, then you're probably going to fail, and your investors are going to move to a different environment. So getting our communication of why we're changing portfolios, what are the kind of the opportunities we see out to advisors in a real-time basis has been kind of one of our technology kind of improvements. So I mentioned operational infrastructure. This is where sort of some of you go to sleep because it's kind of the back end of the investment environment, but it's actually been the area that we've probably learned the most over the 5 years in terms of our scale and how you actually ensure that best execution, compliance requirements, liquidity requirements actually get implemented. And it's developed, and we probably feel that sort of until the funds under advice at Morningstar reached probably $1 billion, then the current process, the existing process worked. As it reached $1 billion, when we were actually rebalancing, we needed to make sure that all those particular compliance, best execution, liquidity requirements were in place. And so we go through a process that probably takes about a week prior to a rebalance date. There are a number of kind of steps that you can see here, but there are, the role of the investment team probably kind of minimized at that particular point relative to the actual implementation and the operational kind of testing with the platforms. We do pre-trade testing. The platforms come back to us with results of that pre-trade testing. We go into kind of to trade and then monitoring. And we've been really grateful to the platforms in terms of the way that they have worked with the ETF providers in thinking about best execution of large licks of money on a certain day. And the use of commercially available tools has been, again, important. In 2012, I'll make no bones for it, it started in our business on spreadsheets. We were doing this on a spreadsheet in 2012. In 2017, we have multiple tools and software and risk monitoring and portfolio monitoring tools available to us. FMO is our source of truth. For those of you that know, it's basically a system that kind of gives us kind of real-time this is where the portfolio is invested. We use FactSet, we use Morningstar Direct for portfolio monitoring and reporting. And then we kind of work with all the different platforms to make sure that that one model and the outcome that we say the model is delivering is actually the outcome that a particular investor on using a particular platform on a certain day is actually receiving as well. I'm almost up in terms of time. Hopefully you've received from me kind of some of our learning of the last 5 years, some of the collaboration that's required in terms of getting the end solutions for investors. It's clear that our industry is changing. Morningstar Research in the US has sort of mainly kind of come out with 4 kind of items that they feel that the sort of investment management firm of the future is going to be focused on. Fees are one of them. Making sure that lower fees through to investors is going to be important. Differentiated investment options. If you're multi-asset, you've got to make sure that you're bringing to the table kind of that differentiated solution. The engagement with the investors, the transparency. In our mind, not being constrained by one particular approach. We feel that just a passive approach, just an active approach, just an ETF approach can sometimes result in lesser solutions for the investor. And we all have to focus on meeting investor outcomes, making sure the performance actually does that. Investors are not going to stay with you very long if you set a certain outcome and over a 3 to 5 year period you aren't achieving that. So we're putting all our efforts into all of these things. We continue to learn and adapt. And we feel very, very strongly that kind of the multi-asset managed accounts, following on from our experience in the US, is going to be a huge growth business for us in Australia and therefore kind of a growth area for this industry in this room. Thanks a lot for your attention.